As our next guest says, it hasn't been an easy year for bond investors. The Fed's continued tightening, an unstable banking sector, and a long debt ceiling fight have contributed to volatility in the bond market. So what should the next move be for investors, especially as the probability for more rate hikes grows? Joining us now is Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Good to have you on this show here. So as you mentioned here in your notes, it hasn't been an easy year for bonds, but what have been the best performers in the fixed income space?
Well, it's actually been the high yield market, which is a little surprising because when you have an inverted yield curve and a Fed determined to slow the economy, typically you wouldn't think about going into the lowest credit quality bonds. But they've actually done well because the starting yields are so high, and we really haven't seen the market price in yet sort of recessionary conditions that would typically make the riskier bonds, the lower credit quality bonds, underperform. But in general, across the board, almost every index that we track in the fixed income market is positive on a total return basis year to date. And that's really because we're starting with so much higher yields than we've seen in a decade or more. That's really helping to stabilize the market and produce those positive returns from the income component.
So here we are halfway through the year then. What's really stood out to you so far?
Well, I think the dominant trend has been the inversion of the yield curve. So on the one hand, you have the Fed hiking rates dragging up short-term rates, while intermediate and long-term rates have just kind of trended sideways to lower. So we've just got this morning, the 2-year, 10-year Treasury spread actually went down to negative 100 again, kind of testing the deepest level we've seen in a very long time, since the 80s. And I think it speaks volumes about what the market is interpreting from the Fed. I think the market is saying, okay, we know the Fed's going to tighten, but we believe they're going to bring inflation down and slow growth. So we're going to invert that yield curve, and longer term rates are going to drift lower. And that's probably the biggest thing, the biggest trend in the market this year.
And what do you think is going to be the biggest risk for bonds, especially in the second half of the year? You have the Fed in this hold status at the moment.
Yeah, the Fed's told us their plan was to hike and then hold and then kind of recalibrate down the road once inflation heads back towards their 2% target. And we seem to be in this transition period between the hiking and the holding period, where you get disagreement among the various Fed members as to whether we've seen the peak or not. But I think the biggest risk would be if inflation doesn't continue to trend down. It's been a lot of focus on the sticky part of inflation in the service sector. I think Fed Chair Powell mentioned it today in his congressional testimony. We're expecting that to come down as the numbers sort of work through in the second half of the year. But if for some reason that doesn't happen, to me, that would probably be the biggest risk in the bond market.
And it is tempting to really sort of hold tight to these short-term investments when you have this sort of volatility. Is this the best move, though?
No, we don't think so. So we've been suggesting investors extend duration, and there's a couple of reasons for that. I mean, it is tempting to sit at 5.5% in a short-term T-bill and just ride it out when you get less, say, in a Treasury yield with a 3 or 5 or 10-year maturity. But you do have some significant reinvestment risk if yields do come down as the market expects as a result of Fed tightening. You'll be rolling over those short-term investments into lower and lower yields. So we think it makes sense to take some duration risk. And frankly, you're locking in some pretty decent yields now, yields we haven't seen for a long time. If we look at not just treasuries, but investment grade corporate bonds or investment grade municipal bonds. I mean, we can build a portfolio now that has very attractive levels of income for income investors that can go out, 5, 7, 10 years. And we think that it makes sense to take that opportunity. So sitting in cash, I know is tempting, but I think in the long run, you do a better job of mitigating your risks down the road by having like a bond ladder or at least extending duration to an intermediate term, 5 to 7 year time frame, so that you have some of that locked away for the future.
And as we look at some of these projections for recession potentially, I know that's getting sort of pushed out to, I think, at 2024 by most economists at this point. But should we still be bracing for more of the same sort of volatility for the second half of the year?
Well, I sure hope not. Volatility in the first half of the year was really remarkably high. Now, some of that had to do with the banking sector problems that hit in March. It's come down a bit since then, and some of it had to do with just the rapid rate of Fed rate hikes. You know, coming into the year, even the Fed wasn't predicting they were going to go 500 basis points or more in this cycle. So I think we've got those two big contributors to volatility behind us. The banking sector still presents a risk. I think the communications from the Fed is even if we get a rate hike or two, that shouldn't boost volatility. Now, volatility in the bond market just reflects uncertainty about the direction of interest rates. And I think we have a lot more clarity on that now. We still don't know where the peak is, but it's unlikely to be as rapid a rate increase as we've seen, or a surprising number of rate increases that we've seen year to date. So volatility should stabilize, I think, barring some big fallout in the banks, maybe as a result of commercial real estate problems or something like that.
So certainly some risks ahead, but perhaps not as much volatility as we've had already this year. Fingers crossed, at least. A big thank you there to Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Thank you for your time this morning.